Hey everyone, welcome to The Explainer. Let's just jump right in, shall we? Today we're tackling a force that literally touches every single one of us every single day, yet it's kind of profoundly misunderstood. Yep, we're talking about inflation. But look, we're not just going to complain about the price of groceries. We're going to explore this deeply provocative idea from economic history and financial strategy. The idea is that inflation isn't just some accident or a temporary glitch in the matrix, but an actual structural mechanism that intentionally shifts wealth. Take a listen to how the financial historian puts it. Quote, "Every time prices rise, you lose a little more of your freedom. You're watching the quietest transfer of wealth in human history." End quote. I mean, wow, right? This completely frames inflation not as a random economic oopsie, but as a deliberate wealth transfer. It's a huge, bold statement, and it forces us to ask the big question. If inflation is a transfer of wealth, who exactly is it transferring from, and who is it going to? So here's our roadmap for today's explainer. First, the hidden wealth transfer. Second, the real cost of inflation. Third, why the wealthy borrow. Fourth, private markets and yield. And finally, number 5, hedging unexpected inflation. All right, section 1, the hidden wealth transfer. So, to really wrap our heads around inflation today, we first have to understand how the rules of money got fundamentally rewritten. It's like a giant puzzle. Before the 1930s, governments were mostly tied to the gold standard. Money was scarce, and deliberate inflation? Totally unthinkable. But then the Great Depression hit and basically changed everything. Prices collapsed, debts got heavier, and the whole economy froze up in this terrifying deflationary death spiral. Policymakers suddenly realized, okay, deflation is the ultimate enemy. Now, fast forward to post-World War II. Governments were absolutely buried under mountains of war debt. Some owed over 200% of their GDP. So how did they handle it? Well, they certainly didn't pay it back by hiking taxes. They just let inflation do the heavy lifting. The debt quietly melted away as the currency lost its value. And then, finally, the nail in the coffin. In 1971, President Nixon permanently ended the dollar's convertibility to gold. This cemented a fiat debt-based economy where money could just be created out of thin air. It was a total paradigm shift. Inflation went from being a feared national emergency to an actual policy tool, a tool that basically saves borrowers at the direct expense of savers. Moving right along to section 2, the real cost of inflation. So, what does this hidden tax actually mean for you and me? The absolutely crucial thing here is understanding the difference between two concepts, nominal interest rates and real interest rates. According to US Bank, the nominal rate is just the stated interest rate on your savings account or bond. It's the number on the sticker. But the real interest rate, that's the nominal rate minus the rate of inflation. And why does this matter? Well, because you only actually make money. You only gain actual purchasing power if your nominal rate outpaces inflation. Well, let's look at the actual math here, because it's pretty painful. Imagine you buy a bond with a 5% nominal yield. You're probably thinking, great, I'm making 5%. But if we're living in a 3% inflation environment, your real return is only 2%. Your purchasing power is barely inching forward. And what if inflation rises to 6%? Well, your real return suddenly goes negative. You are quite literally paying just to hold on to that investment. No way to build wealth there. Which brings us to this terrifying real-world example for the everyday consumer. US Bank calculates that if you need 50 grand a year to sustain your current lifestyle, and annual inflation is just a modest 3%, well, in 30 years, you're going to need roughly $121,000 a year just to maintain that exact same buying power. Think about that. Your savings have to work incredibly hard just to stand still. Let's pivot to section 3, why the wealthy borrow. So, how do the absolute wealthiest folks handle this reality? Simple. They flip the logic of money totally on its head. Let's look at this hypothetical scenario from First Tech. Imagine you inherit 100 grand. Option A, you pay off a $100,000 mortgage that has a 3% fixed rate. Or option B, you invest that 100 grand into a portfolio averaging 6% annual gains. Now, for most of us, option A feels safer emotionally, right? Pay off the debt. But mathematically, option B leverages that relatively cheap debt to build wealth, while simultaneously letting inflation basically shrink the real underlying burden of that mortgage over time. And this dynamic right here is the core strategy of the ultra-wealthy. They often don't even take a traditional income. Most of their wealth is tied up in highly appreciated assets, like company stock or real estate. If they sell, boom, they trigger massive capital gains taxes. So instead, they use something called securities-based lending. They borrow cash against their assets at pretty low interest rates. Their assets just keep compounding and growing, they completely avoid the tax hit, and here's the kicker, Every single year that inflation rises, the real value of the debt they owe actually drops. It's an unbelievably powerful wealth-building engine.
Okay, section 4, private markets and yield.
Now, to actually pull off that strategy, you need investments that yield way more than inflation. First up on the list, collateralized loan obligations, or CLOs. According to Western Asset, a CLO essentially issues debt and equity to buy up a big, diversified pool of floating-rate secured corporate loans. The absolute magic here is the yield. Get this, since 2014, CLO equity has averaged a 4.4% quarterly distribution. Quarterly. That translates to an annual income well into the double digits, easily crushing inflation. Plus, they have this built-in optionality. In a bull market, they refinance their borrowing costs to be even lower. In a bear market, when spreads widen, actively managed CLOs can reinvest at even higher yields. It's a remarkably adaptable inflation hedge. Next up, we have private credit. Historically, there was this massive shift after the 2008 financial crisis. Basically, new regulations forced traditional banks to step way back from lending to middle-market companies. Well, private credit funds stepped right into that void. BDO Wealth Advisors points out that private credit essentially acts as a replacement for banks, offering investors a steady, recurring income. And crucially for what we're talking about today, these instruments usually feature floating interest rates, meaning as central banks raise rates to fight inflation, private credit investors actually pocket higher income. Win-win for them. And of course, you can't talk about inflation without talking about private real estate, specifically value-add, multifamily residential properties. As BDO explains, this acts as a super direct inflation edge. Why? Well, because rents are variable. Historically, they tend to rise at roughly the same rate as inflation. Property owners can go in, upgrade units, increase occupancy, and just raise rents to keep pace with the rising costs happening across the wider economy. It directly protects the investor's purchasing power.
All right, last up, section 5, hedging unexpected inflation.
So those strategies we just talked about, they work beautifully for steady expected inflation. But what on earth happens when inflation catches everyone off guard? Morgan Stanley draws a really vital distinction here. When inflation is expected, meaning, it's already priced into the market, traditional stocks and bonds do just fine. But when we get unexpected inflation, the game changes entirely. The discount rates used to value equities and bonds suddenly reset higher. And when that happens, the prices of those traditional assets drop. So just when your purchasing power is getting hammered the hardest by an inflation shock, your traditional stock and bond portfolio is losing its market value too. Not great. And this brings us to the ultimate historical wildcard asset, commodities. The physical reality of global trade, things like energy, metals, agriculture, they just act differently. Morgan Stanley's research shows that when unexpected inflation hits, commodities tend to reprice to the benefit of the investor. Why? Because those recasted inflation expectations get almost instantly reflected in higher forward prices for raw materials. Let's look at the hard data, because the numbers don't lie. This table looks at performance during quarters of unexpectedly high inflation between the years 2000 and 2024. A diversified basket of commodities delivered an average quarterly return of 3.93%. I mean, that is drastically outperforming everything else. It more than doubled real estate investment trusts, which sat at 1.48%, and completely crushed U.S. equities at 1.08%. Even TIPS, Treasury inflation-protected securities, which are literally designed for exactly this scenario, only managed 0.92%. The takeaway, when the inflation shock hits, hard assets win, for sure. But there is a catch, and it explains exactly why you can't just buy a bunch of oil and call it a day. History shows that leadership within the commodity space constantly rotates depending on the crisis. In the 1970s, agriculture and precious metals led the charge. In the 1990s, energy spiked. But in the post-2020 inflation surge, energy and agriculture surged, while precious metals actually went negative. It's basically impossible to predict whether the next inflation shock will come from an oil embargo, a supply chain collapse, or a crop failure. And that is exactly why institutions use a broadly diversified basket. They want to ensure they catch the upside wherever it happens to pop up. Which leaves us here. As we've seen, inflation is a structural reality. It's this silent tax that erodes savings but vastly enriches those who understand how to use debt and alternative assets. The wealthy aren't playing by different laws of physics. They are just playing by the new rules of money that got established over the last century. So I'll leave you with this provocative question to ponder. Are you positioned for the reality of inflation, or are you just holding cash and hoping for the best? Think about it. Thanks so much for joining me on this explainer, and I'll catch you next time.